All right, we are back. Welcome back, everyone, to this Applied MMT live stream. Mr. Ty, how you doing, man?
I'm doing good, buddy. Real good.
Good, good. Um, yeah, we're in for a good show tonight. Got a lot lined up. Going to be a bit of a potpourri episode where we hit on a lot of topics tonight. Have a lot to cover. And yeah, we're just going to let the wind guide us as it may in terms of the wind of discussion guide us in terms of where we end up. But chat, welcome. Glad you're all here. Tariffs just announced. Ozzy Oz, yes. Yeah, we'll get to that. I'm seeing that. I think if I saw about a half an hour ago, S&P futures quickly tanked about 1%. So I'm trying to look this up on the phone as we go live. But I don't think markets greatly appreciated the tariffs. I'm seeing some headlines too, Ty, just to kind of get you in the loop, and I can jump over to that screen chat so you all can see this as well. Give me just 1 second. All right. I'm seeing from, this must be today at 6:35 on Truth Social. As everyone is aware, thousands of people are pouring in through the borders. Right now, a caravan coming from Mexico, composed of thousands of people. On January 20th, as by many first executive orders, I will sign all necessary documents to charge Mexico and Canada 25% tariffs on all products coming into the United States. And its ridiculous open borders. This tariff will remain in effect until such times as drugs, in particular fentanyl, and all illegal aliens stop invasion of our country. Both Mexico and Canada have the absolute right and power to easily solve this. All right. I'll digress about the border issue, but it does look like this is going to be a day one thing for 25% tariffs out of the gate. And I guess, I don't know, Ty, I think the things we kind of had teed up for tonight is to go over what will, apparently be maybe day one Trump policy, implications of Trump policy, where we're at in the macro cycle, 25% tariffs. It seems like quite a lot. Ty, I guess maybe a good place to start when it comes to the whole tariffs discussion is just in terms of, take the policy and politics out of it. I wonder if we're going to get a 25% tariff on importing you digitally from Canada into this amazing live stream. I wonder if any super chats, 25% are going to have to go to the government coffers. I guess we're going to find out. But Ty, maybe tariffs are a pretty simple process when it comes to what the implication is from a flow standpoint, right? I mean, they would just head right into the Treasury, correct? I mean, it is just a deficit reduction, right?
Yeah. It's simply a tax on U.S. firms at this point. So it definitely help the coffers. The Trump narrative, right, of reducing the deficit. That's for certain. It's unfortunate, we kind of expected this, but I expected it to be kind of in unison with corporate tax cuts and firm tax cuts across the U.S. economy. So essentially, it would kind of zero each other out, right? Because they're just taxes on U.S. firms.
Yes.
So if tariffs go up, corporate income taxes go down, firm income taxes go down. And there'd be no net effect there. The biggest question is, what does Trump do with spending cuts? That's ultimately, I think, the biggest question. However, on this news, if he does go through with these tariffs, and I guess that would be in the United States in an executive order for him to do that, so he could do it right away. That's problematic for the U.S. economy and in specifically large firms that are importing their goods from abroad. And then ultimately that's problematic for the consumer because those costs have to be passed off somewhere. My hope was with the addition of corporate tax cuts and firm tax cuts that the cost for firms wouldn't be excessive on any tariffs and they wouldn't have to pass off any costs to the consumers. And if there were cost pass offs, they would be relatively small and inflation wouldn't be a big issue. But if you implement the tariffs first without any tax cuts on the income side of things, that's immediately problematic for the U.S. Not problematic for Canada or Mexico. The U.S. Needs our stuff, right? That's not going to change. You'll keep buying it. Unfortunately, it's the consumers down there that are going to ultimately get hurt right away by this.
So I'm thinking too, just in terms of kind of our overall kind of macro forecast, at least in terms of, let's just say this, that from some of the stuff we showed off during the last stream in terms of where we're at with our forecast model. I mean, right now we're looking at that we're still in that last valley of this next cycle, if you will. We are just getting ready to emerge bigly into like say the second half of 2025. And what I'm wondering is, and kind of what my thought process is here, is that I think the big surprise by say 2026 is going to be inflation as we round out 2025. But if that is the case, could inflation come early because of the markups that'll get passed along from the tariffs, or would it be that the tariffs end up doing such a dent to deficit spending that in fact this last, I guess the way I'm looking at it is it's almost like that the cycle, and this is just based on kind of the various simulations that we've been running with MESSSi, is that the cycle is like just being suppressed underwater is almost what it looks like an inflated ball underwater that's just starting to slip out of your fingers and getting ready to shoot up. I mean, that's really what it looks like is happening here. But it almost seems like we are going to be at an inflection point where, maybe that happens, and maybe the markups just get passed. I'm sorry, maybe the tariffs just get passed along as markups, and that's just more inflationary pressure, or maybe it is just enough to actually push the ball down deep enough where the pressure of the water just pops the ball, and we never get a run up coming into the second half of 2025.
Yeah, so I would err on the side that this is going to be deflationary, actually, because it'll affect firms right away. It'll affect their income. And hence, even though these are importing firms, they're hiring domestically. So that's going to impact hiring domestically, output domestically. And there could be some inflation from it. I wouldn't say it's going to be through the roof. You got to remember, 25%. Is it going to be just Canada and Mexico? Obviously, he has plans for China. What about Europe? Right?
Yeah.
So, and this is again Trump talking. So I wouldn't say it's going to be heavily inflationary. If anything, I would say it's just going to suppress the economy a little bit more than we're already kind of predicting for the first half of 2025 before it pops. The danger of it, because we kind of look at the economy as a nonlinear system, and we now actually have 5 models running. So the thing with a nonlinear system is if you push it too far to one of its ranges, it can become unstable. So, and we could actually see a huge overheating. So we're kind of, in the long term, late 2025, 2026, we're expecting a pop in the U.S. economy. Now, we don't want that pop to be an overheat asset type bubble, overall, right? So if we drive it down too far now, we kind of risk, it reaccelerating at a very high rate in the later part of 2025, 2026, and that becomes problematic. So my hope is it's not too depressive. We're going to still run the simulations and kind of figure it out, and we'll definitely publish that. But I would suggest it's not going to be instant inflation as soon as you see the tariffs. What I'd be more concerned is jobs and jobs growth and wage growth. from this, because you're affecting productive firms by essentially taxing them on the business they do with countries abroad.
Yep. Speaking of that blog, we post that. If chat, you are interested, the technology that we're building out, we're currently calling it MESSSi. We're going to try and come up with maybe a better strategy to communicate exactly what that is, but we do see it as very pioneering technology in terms of system dynamics and forecasting. But if you're interested in that blog and in those updates when they drop, obviously, if you're an active trader, active investor, head on over to AppliedMMT.com. You can get everything that I publish over there for that. But if you're just kind of looking to keep tabs and to keep up with what we're doing, we did launch a website. You can go to modernmacrotechnologies.com or just modernmacro.tech as well. Click the blog, and that'll bring you to the blog if you're interested in keeping an eye on what we're doing. And I think, you can sign up, drop your email over there as well. And if you do happen to be an institution and you're interested in some of the technology we've built and how it can help you too, we've got a little forum up there as well. But either way, if when we drop our next little post in terms of where we think we're headed from our tech, that is where we have that. So, Ty, what's really interesting too is I didn't tell you this over the weekend, but I was messing around with some simulations, and one of the things I noticed, speaking about getting too hot, is I noticed if we do end up getting through, and we'll talk about some of what is on what's on the docket for the Trump administration and kind of the implications of that. But it does seem like there is a big movement afoot with Elon Musk, Vivek Ramaswamy, Trump, and even the new Treasury Secretary that sounds like was announced, was it yesterday, Scott Bessent, that there's a big push to go ahead and get some major spending cuts. And the implication of this, so I was trying to simulate what would it even look like to actually get $2 trillion in cuts all the way through, and what the implication of that would be. And what I ended up finding out is you can get $2 trillion of cuts in, but the minute I started running the simulation past 2028, it wouldn't compute, right? We had a full system collapse akin to what you would get, back in, say, 2008, where you just end up getting yourself into such a unstable system that you can't compute that far out. Now, I'm not saying that we're destined to get there, but what I'm saying is I'm tracking with you that we could see ourselves, instead of, we've seen since 2020 a massive bullwhip move, right? The shutdown in 2020, followed by the massive 10% increase in GDP, massive stimulus, followed by inflation, followed by effective collapse in 2022, followed by kind of the reboom in 2023 and into 2024. And we're finally now into a spot where the endogenous mechanisms that are driving the macroeconomy are ready to just get into a little bit of a cooling period in terms of this massive back and forth. And we're about to induce a shock or institute a shock into the system at a time where this system is finally finding some I'm going to use this term in the most non-economic way possible, but finally finding some equilibrium in terms of some stability. And I'm thinking that we're kind of onto something that we could be setting up for a very big kind of boom bust cycle as we head through 2026, and then I think ultimately the bust happens in 27, 28, maybe even as we head into the next election cycle. So some thoughts there. I don't know if you have any other thoughts in terms of. By the way, I'm reading. I see that Elon put America's currently headed for bankruptcy super fast. We can discuss that in just a minute, but the last budget surplus was in 2001. I wonder if anything happened back in, say, the late 90s, early 2000s. Yeah, I don't remember what the economy was like back then. Huh. Yeah, maybe we should just get back to those surpluses and see what happens.
For as smart as Elon Musk is, it's pretty funny. In one sentence, he says America's headed to bankruptcy. In the next sentence, he's saying America's printing too much money. You can't have too much money and go bankrupt, right?
That is a very good point.
I don't quite get. I think he's good at rocket science and engineering and stuff like that. Give him credit where credit's due, but his economics is based on neoclassical stuff, and it's fraudulent at best. And as for government spending cuts, that's my biggest fear. So it's not really variations in tax rates, variations in tariffs. It's ultimately spending, right? You got to remember that GDP in the United States, 35% of it is from the government. That's not a bad thing, right? The government spending is giving profits to firms, right? Those firms are employing people. Those employed people are then buying things.
Yes.
Right? It's just it's a component of GDP. Why would you want to stop doing that? Like, I don't quite get that, but it would be damaging. So some of the initial numbers I heard, Elon wanted to cut 2 trillion, right? And you guys really only have 1.3 trillion in discretionary spending before you're cutting like old age pensions and whatever healthcare you got down.
Yeah.
Right. So I don't know how practical that number really is, but let's say you just cut the 1.3 trillion. Well, if you take that, it's what the government spends about 6 trillion a year down there. There's 20%. What is it? 18% cut there. So you can imagine reducing exogenously reducing the amount of spending in the economy reduces GDP, right? It then reduces jobs. So it's a silly thing. If you look at like all the data across a lot of like developed Western countries, government spending per GDP sits around between 30 and 35%, and it's stayed there, since the 1960s, essentially, because that's that happy area where there's resources available, workers available to employ all that, and it's healthy for the economy. The government can keep that spending stable through any boom bust cycles. It can reduce if it needs to reduce. It can increase a little bit if it needs to increase, which it did during COVID. And we had the shortest recession in history. But to just artificially knock that off after decades of success and the U.S. being on top of the global theater economically, it's really quite bizarre thinking. And all I can think of is all these people are reading some classical textbooks that say, well, that's what you need to do. But we haven't been doing that. So it's bizarre to me.
The one thing is if you're convinced that government spending was the main cause of inflation and the last thing you want is inflation, then cut government spending and you'll never get inflation again. I think, though, what is missed when you're not using a system dynamic framework is you're not seeing every input to inflation, right? And we have run simulations. If you get rid of all the government spending, instead of, we've ran this in prior live streams before, but if you run a simulation where you get rid of the entirety of government spending, you just keep government spending as it would have been, you end up in a scenario where instead of inflation getting to like whatever it got to 8 or 9%, it gets to like 6 or 7%, right? So you're 2% lower, but you still have a massive inflationary push, and you end up paying for it on the back end with even higher inflation the next cycle and higher private debt, lower wages. The whole bit is that you just end up with a less productive economy out the back end as well.
Yeah, and actually, so it depends on the type of government spending. So a lot of the government spending during COVID, and I can run the test, right? If we had eliminated that, actually inflation would have been persistent for longer, right? Because it gave the financial assets for firms that were struggling with lockdown effects to be more productive and increase productivity and actually lower inflation on the back half. The direct household payments were definitely inflationary, but they solved the problem of the financial obligations households had, i.e. mortgages. you don't pay your mortgages, then your banking system collapses, right?
Yep.
And then we got 2008 all over
Yep.
again. So
Yep.
it's government spending is just a part of the economic engine, right? And we've never, ever, I can't really find any documented history where any nation had been completely excluded, whether it was a king or some ruling class or a democracy or a republic, just not spend money. That's what governments do. They spend to keep a social cohesion in the economy. That's just a normal
Yep.
part of a nation, right? So the narrative that it's bad is ridiculous. It's quite frankly, it's ridiculous.
Yep. Yep. So we will find out, obviously, when he gets in office, what the impact is going to be. And I will say, I posted this earlier too, as well. And this is federal debt to GDP level for the U.S. and then also the distribution of household wealth in the U.S. And the point here is not to make like a political class war statement or anything like that. The point here is just simply to say that when you get yourself in a situation where you actively, well, I mean, obviously in the 90s and into the aughts, it wasn't, I don't think it was a conscious active decision in the way that it is today, but when deficit reduction, or really I should just say when government spending is sideways and you want consistent GDP growth, you're going to get that from private debt creation. And when private debt creation occurs to drive growth, that does drive the wealth disparity. It drives the wealth inequality. Really, yeah, we'll just call it wealth disparity. And it's a very simple reason is it's good to be on the receiving end of interest payments, right? That's really what it boils down to is when the government issues the debt, which means it's just spending into existence, it's not the bottom 50% that are having to foot the bill for the interest payment. When it's the private sector that is issuing the debt, it's being issued to the bottom 50%, and they're having to pay the interest bill, and that is just the very basic dynamics. Now, again, you could have a policy where you're saying that's great. I don't care to get in necessarily to the class warfare stuff, but what you do, and I mean, as we found out in 2008, is that undoubtedly builds the fragility of the banking sector, right? A large private debt bubble is not good for financial stability, and that is if we end up getting these major spending cuts through, and that ends up being the pace that gets set through the next 4 years of this Trump administration, we're going to find ourselves back in a very similar but different situation as we were at the end of our heading into the great financial crisis. Now, as of right now, there's, I mean, deregulation is on the table, but there was obviously a lot of regulation. Basel III, I think, put the banking sector in a lot better footing. I think it'd be a lot more difficult to get into a 2008 all over again, but still, we'll find ourselves in whatever banking crisis we will find ourselves in, and that's MMT 101, right? I mean, I tweeted that out again today, where it's like, look, by the end of this administration, if we get these spending cuts in, we're going to get a whole new generation of people finding out who Hyman Minsky was and what he talked about in terms of, oh yeah, things are feeling pretty good now. Maybe we should deregulate and let banks start making crazier and crazier loans. And I think we are absolutely we are at that point right now where we're going to get there. So I've got Rominium 14 asking, can they cut spending and lower interest rates? Actually, Stephanie Kelton sent me this, her the Lens Substack, and I mean, that's her point. And her most recent post here is just a very easy way to do this is to just drop interest rates to zero. And all of a sudden you got your $2 trillion right there. That's all you need. Just cut interest rates. And I think that's going to be the most difficult thing in all of this too, is that and Jeff Stein had a good article on this as well, and Ty, you were just putting making this point as well in terms of finally getting to discretionary spending, right? I mean, the vast majority of spending is not exactly easy to put on the chopping block. And Jeff Stein called up Richard Pierce and pretty much laid out that it's going to be very difficult for Doge to do the sort of enforcement that they want out of the gate. Quite ironically, the bureaucracy to stop a government agency coming in and doing massive cuts is pretty substantial. So at least according to Jeff Stein in his research, it's going to be a difficult thing to pull off. But I mean, one thing that I think MMTers and the Trump administration and I guess that would include Elon as well could all get behind. If you want to cut spending, just drop rates back to zero. I mean, just say, hey, we gotta get, yeah. If anything, the MMTers and the Fed crowd can get together and say, yeah, maybe the Fed shouldn't be going into a secret room and having meetings to decide what I know the minutes come out eventually, but make some arbitrary decision on where the interest rate should be. Maybe that should just be set by Congress by vote, and maybe it should just be set at 2% or something like that, or maybe target interest rate to GDP ratio or interest income to GDP ratio, something like that. And yeah, I mean, that takes care of any spending issues. In terms of interest rates being at 5.5% for a year, which I think at the end of the day tallied about $1.5 trillion of interest income for the private sector over that amount of time. So a lot of options on the table if you want to cut spending in terms of without having to actually cut spending that's going to go to people who are highly dependent on it.
I think I try not to be political here, but at the end of the day, like if Trump really wants to make America great again, you got to focus on the real aspects of America, right? And that's production, right? Domestic production, things of that nature, and productivity, by firms, right? But that all requires, the effort of the federal government to essentially fund those things, give the financial assets to those private sector corporations and big, large firms and medium firms, and small mom and pop firms, right? And allow them to be very productive in the private sector. You really want to help America. That's what you got to focus on, not scoreboard numbers of the national debt. It's meaningless, right? It's not actually the root of the issue, right? The issue is you want to look at the productive capacity of the U.S. economy. So instead of focusing on what Canada can produce for you, produce some real nice stuff. Our trees are nice. Go ahead, tax yourself on our trees. We don't care.
You produce those?
Yeah, we grow them, right? You go ahead. You want to tax those washing machines that Mexico makes for you? Go ahead. They're still going to make the same. I don't care. They're just laughing at you. Not you specifically. More Trump. So that's the wrong focus. You're focusing on other people's production when you should be focusing on your own domestic production and what affects it, right? And it's completely bizarre to me. And it's a bit of a circus in a lot of ways. I'm starting to sound like Trump describing Trump because it's that crazy.
So, I mean... It is difficult because it feels so close yet so far away in terms of like it very much is like what could be, right? I mean, there are things that I don't love about Elon Musk, but if it was like, hey, we should be spending a lot more on NASA, we should be spending a lot more on truly making America great again, in the sense of like, when you think about the great things America has accomplished that has benefited the entire globe, why aren't we investing in that? But I'll digress. The election is over, and now all we can do is analyze what's playing out as we head forward. So if you're watching this and you're not entirely convinced, I just in terms of, or you just really want to understand this whole government spending aspect and why we're really hovering on that exact aspect, what I want to do is switch on over to, and in fact, we'll actually pull up the data from AppliedMMT, which again, if you're an active trader, active investor, head on over there. And this is, all the tools and everything that we have available for that are available here. But head on over the month. If you check out the monthly treasury statement, and I can pull this over. And so what I do, and I think this is so helpful as a visual to understand why government spending is so important, is I do a lot of cumulative deficit spending. So what I'm doing is I'm literally just adding up the deficits month over month and essentially creating a national debt. But the reason particularly that I'm doing a cumulative approach for just the deficit month to month is because I'm really trying to get the essence of the flow of fiscal spending into the private sector and then divide that by inflation. Because when the government's spending, that new dollar is only as, we'll call it, potent or efficacious as the amount of dollars that are already out there in existence. So divide that by inflation and then do a year-over-year percent change to effectively approximate the flow. And so that's what's on your screen right here. And what you can see is consistently going all the way back to the 1970s, and this explains the two recessions we had in the 70s quite well, is that when deficit spending reduces enough to get into effectively a surplus period, right? So deficit spending slows enough where we are in an effective surplus in real terms, that is when you enter recessions. And it all comes back to this very basic kind of MMT 101 idea that when the government spends, that adds financial assets to the private sector, right? That is the Levy-Kleske equation, profit equation, kind of basic heterodox balance sheet 101 sort of stuff, that the source of profits is government spending, and that's why flows are so important. So if you're looking at this from just a big picture health of the economy, the macroeconomy, especially from kind of, if you're looking to invest, if you're looking where assets are asset prices are going to go, if you're looking for kind of the growth profile of the macroeconomy, start no further than this. When this chart goes negative, that's when alarm bells should be going off. And in particular, because not only is that government spending a source of profit for the private sector, but it's also adding as that first layer of capital for the private sector to kick off what really is the engine of capitalism, and that is that endogenous money creation to create the new production that Ty was just talking about, to create and expand the economy to grow and meet the new demand that is out there. You take that away, then all of a sudden you take away the government spending, then all of a sudden the very endogenous nature of the private sector money creation eventually, and this is kind of Steve Keen 101 sort of stuff, it will collapse on itself, and it always does. And that's why every time you get a major crisis, you get two things. You get deficit spending flipping, going either near zero or in reverse, and then you get a sudden very strong pop in the credit cycle, and it's a very strong pop in the credit cycle that never ends well. And going all the way back to the top of the live stream, that is what I think. Ty and I we're very much in agreement here. There's a very realistic chance that, say, by 2026, 2027, it's going to be very, very clear that is what is playing out, and we could very much be at the top of that cycle. So keep your eye on this chart right here, especially if you've got money at play and in this macroeconomy. This is certainly a data series amongst many that you want to be aware of. Ty, what else? Yeah,
it's still very problematic to. It's almost, I find more uncertainty over the next coming 2 years than I would have had uncertainty. Let's say if we start in 2021, the pandemic's happened, I could clearly kind of see what was going to happen over the next few years. Trump is a bit of an enigma to everybody. And one of the things that's going to become problematic for the economy is Trump is going to alienate some of the people that have helped him get into office. And I'm looking at from Scott P. Elon would love to increase NASA's funding, SpaceX as a contract with NASA. There's was a little bit of talk because Trump wanted to take away some tax benefits for buying electric vehicles. And Musk has come out, and I can't remember what article it was, where he didn't quite agree with that for obvious reasons, right? Tesla. So there's so much uncertainty on, what's going to be taxed, right? And this is another thing, Tesla imports things, right? So,
yes.
Yes. That's part of its business. Big businesses in the U.S. are importers, right? So it's very questionable, what's talk from Trump, like the tweet we saw there on, I guess that was from True Social.
Yep.
So I'm sure Elon Musk is about to buy out. That's probably going to happen, but it's very hard, right? We all know that Trump talks a big game, but at the end of the day, what really comes? We saw his first 4 years. He talked a big game, but a whole lot didn't change policy-wise. So that it's really, markets will react to all this news, but at the end of the day, how much of it's going to actually happen? I will say this, kind of in my outlook, the less tinkering that happens going forward, both by the government and the central bank, we're in a good position. Like the U.S. is in a really good position. The bottom of this business cycle isn't going to be a recession. Things will keep humming along. So that's the unfortunate part, because I see a lot of stability, all things equal, going forward.
Yes.
That's the sad part. And I wish, we hear all this rhetoric from Trump about, the government's influence on the economy, but no rhetoric about, banks' influences on the economy, a bloated financial sector. I know both me and you, make money from the financial sector. And there's a size for it. There's a place for everybody to participate in it. But we also know it's in the United States, it's a little bit unrestrained in a lot of ways, right? And it's sad for me to see him, address, one part that could be an issue, maybe government inefficiency. Sure, I completely agree. There is federal government spending out there that is not efficient, and it should be looked at.
Yes,
right? And it's been baked in, grandfather. I'm all for that. Go ahead, do that. That's due diligence of any government, right? And as citizens of any, Western country, we should expect that from our governments. But at the same time, we're not looking at the underlying things that cause instability in the system, and that's generally the finance sector. You'll be watching. We're all into stocks, and we can have all that. But we do have to really focus on that side. That is the part of our Western economies that have really grown over the last 40 years, right? And there's no word from him on addressing any of that. So,
which is, and I mean, again, I think that is really where we are headed to is just another. I mean, we're really sowing the seeds of a financial bubble is really what we're doing, and unlike, say, 2000 or 2008. Well, I don't want to say unlike. I would say the one thing that's very different from today between 2000 2008 and where we're at today is we're starting from probably a much closer spot to the ceiling of where private debt to GDP could get before you start getting very sensitive to even the smallest kind of accelerations or decelerations in credit. And so what I mean by that is if there was a big credit buildup for, say, 10 years heading into 2000, and then it was about 5 years heading into 2008, it could easily just be a 2 or 3 year buildup before things get very, very sensitive to even the slowest deceleration of credit. And I don't know if we would have a whole election cycle or two before crap kind of hit the fan, that it really could be a relatively fast move. But yeah, I agree. I mean, actually, in fact, if Trump just kind of came in and did very little, quite ironically, if he just kept the status quo, he would actually see very stable fall in inflation and moderately strong growth. I mean, I think the one thing that if he really wanted to get his hands dirty with in terms of, kind of direct government intervention, it would be getting more oil out of the ground in the U.S. That would definitely take away a headwind for inflation and add some overall stability on the inflation front, which again, I really do think we're going to have another wave of inflation come 2026 that's going to be more than your normal, definitely nothing akin to what we saw post-COVID, but it's going to get from where Trump wants inflation to be to where inflation will be. It's going to be a little difficult to kind of manage from a PR standpoint. So any getting ahead of that will be beneficial, and so I do think kind of the oil aspect wouldn't be a bad idea. But with that being said, going back to your original point, private debt is really where the risk is, and that's just. But again, this is what's wild. Okay, I'm gonna just take a step back, and I remember following the Great Financial Crisis and trying to understand what was going on. Finally hearing about Hyman Minsky, and I just remember kind of hearing, and I remember listening to lectures that Steve Keen had and about Minsky and Minsky's big point that eventually there comes this point where kind of society just forgets about the last crisis and like that it was. I mean, anyone who's over the age or around the age probably, because I'm 40 years old. I would have been in my early 20s as we headed into the Great Financial Crisis. And so I still have a very distinct memory of it. And so anyone who's at least 40 or older is well aware that was a credit bubble that burst because of deregulation and a lack of, I mean, obviously, we're aware of this, but a lack of government spending at the time. And yet here we are, not even 20 whole years later, saying, let's try and replicate what we did 20 years ago that caused the greatest financial crisis. And we're trying to pull it off again to essentially do the exact same steps that we did to get the last credit bubble up. And I'm not against. I'm not even trying to say that we should engineer credit bubbles out of existence. What I'm trying to say is that they're going to happen. So let's just get some good policy in place to make sure we manage the creative destruction that comes along with that. And I just remember thinking like, no, there's no way that 20 years down the line from now, people are just going to forget Minsky, right? And no, here we are. Like, we forgot about not Dre, but Minsky this time.
Yeah,
so.
I think it's important to embrace, the non-linearity of the economy. There's going to be times where there's booms, and there's going to be times when there are busts, right? But looking at it from a nonlinear system, that if you kind of keep all things equal, you'll sail through those ups and downs. But when you make drastic policy changes,
Ty, I'm gonna pause you right there. Is anyone else having issue hearing Ty right now? Yeah, Ty, you're I will. All right. I was wondering if that was just me or if that was everyone else. Ty, if you can hear me. All right, I put that in Discord, Ty. If you can hear me, I feel bad because Ty, I think what you were trying to say was very profound. Let's see. As Ty figures out his mic issues, what else Ty, feel free to cut me off at any time if you feel like it's back at it.
Oh, I'm just trying to
There we go.
work out my headphones here.
All right, I'm hearing a little feedback as well. So, all right,
Yeah.
I think we're good now. Okay. Do you want to give the profoundness one more shot? What was the essence of what you were just saying, I guess? I don't know if you can hear me now. All right. Let's do this. Let's switch gears.
Okay.
Oh, perfect. Let's go.
The crisis is over. Okay. So what happened is my headphones went out. So I don't know what anybody. If I went dead.
You went dead pretty early. Yeah. I thought it was me on my end, but do you want to give a quick summary?
I learned audio best from Steve Keen. Yeah, he has a world of audio and video problems on the live stream. I'll tell you that. I don't know where I said a bunch of profound things that I thought, oh Jesus, I'm sounding really good, but yeah, wherever it cut off, who knows, right? So, what was the last thing you guys heard?
I don't think we really heard much of anything.
Oh wow, that's terrible because I can't reproduce
that. Yeah, reproduce greatness.
So basically, I was comparing. We look at the economy as a nonlinear system, much like climate scientists look at weather as a nonlinear system, right? And I don't know if I made it to this part, but we adapt just fine to the ebbs and flows of the business cycle, and so long as either end of it doesn't get too extreme, we'll make it through to the other end. And like I was saying earlier, all things equal, we'll be fine going forward. But as soon as you start doing massive changes like a big chunk of government spending, it's the same thing as in those climate models where they introduce more methane gas or CO2, right? It brings the system outside of that stability range. Like in nonlinear systems, you think about a saddle on the back of the horse, right? And the saddle could have lips on the outside of it, and you roll a marble in it, and it'll go in all different directions, right? It's a chaotic system, right? But if it goes over a certain lip on the edge, it just falls off the other side and the system breaks, right? And there's no return from it, no matter what you do at that point, right? So that's kind of what I was saying. I think I said some more profound things, but I guess it'll just be lost.
It'll be lost. Yeah. You gave away the secret of how our strategy is making currently 120% return year over year.
Yeah.
Gave the secret away, but it's lost to history. Oh well. Sucks to be you if you weren't able to read. I guess there could be a lip reader out there that now knows the secret. Let's see. I think I've hit pretty much the things that I wanted to hit tonight to get the stream back off the ground. I will say a couple other things too that are just probably worth pointing out that were kind of in my tweet deck, if you will, to go over. This chart right here that's been posted a lot over the last 2 or 3 years that continues to get posted about remittance from the Fed. It used to be remittance from the Fed to the Treasury. Now it's negative. So in other words, the Fed is paying out. The Fed is not losing money in any meaningful way. Technically, the Fed is paying out. The Fed is just paying out because there are interest on reserves. And the only way that the Fed can hit their target rate is to issue interest on reserves. So when you see this chart, just realize all this is the Fed paying interest on reserves out. This is neither a good nor bad thing. This is just simply banks getting free money on their reserves because the Fed has to hit its target rate. Okay, so the way the Fed pulls off economic policy is they think the higher interest rate is going to diminish economic activity. And the way they like to do that is they like to reduce economic activity. Hopefully people can't buy homes, get people unemployed, do something like that to reduce demand. And the offsetting payment for that is spending billions into banks, right? So this isn't the Fed going broke or anything like that. But I thought I'd pull this up in terms of just people not knowing some basic monetary operations, which is apparently all in vogue. One last thing I'm going to pull up, and I've pulled this data to go ahead and the source of this. There's this relatively new, the U.S. Census Bureau has a survey they've been doing, the BTOS, and I forget what BTOS actually stands for. I think I have it up on my phone still, but either way, it's some really interesting business trends and outlook survey. What's really interesting is this survey has a question about how much you intend to increase hiring into the future, and it's 6 months out. So the orange line is going back to, we'll call this August. The future projection is for no increase in hiring going back in August. But now all of a sudden we're at almost 6% is what the anticipated rate is going into November. Now I wish this data, we had more of a track record. They've only been doing this for 2 years now, 2 or 3 years. And like I said, he only pulled this back to 2023. I think I can get it back another year or two further from this based on some data I was able to pull out. And I've got the API that'll piece together. But very intriguing.
Are we supposed to be?
Go ahead.
Are we supposed to be seeing something on the screen?
Yes, you are.
Yeah, we haven't seen anything. We didn't see the last chart either.
Wow.
I knew what you were talking about. So here we go. Yeah, there we go. Wow, incredible.
These guys, I mean, and
Glad we got to see it.
Larry Summers jumping in just in time to let us know that we are the best. Larry, it would have been nice, Larry, if you were paying attention more to the stream.
I don't think Larry Summers very observant on anything.
Here's the chart that I wanted to talk about with regards to the Fed and the $200 billion, and then here's the chart for the future forecast for paid employees. And this again is coming from the Census Bureau. So this is really interesting just to see that as of right now, current hiring has not been accelerating, but the demand for future hiring is picking up, which again, from our forecast, and you can check out the last stream, we went a little bit into this, but our forecast right now are really like, hey, 6 months from now, we really anticipate things to really start to heat up, and we're getting a good kind of at least confirming indicator. Obviously, this is a survey, and a survey will be what it is, but some exciting data to go along with what it is that we're seeing, which is kind of a flat first half of 2025, but then the second half really taking off, and we're starting to see that. And speaking of which, wanted to point this out as well, which is I'll fast forward this all the way. The New York Fed's nowcast on GDP is 1.9%, which again, we're seeing some downward pressure on GDP ourselves in our simulation. So coming in line with kind of where we're at, that we might be getting a little bit of a surprise to the downside to kick things off as we head into Trump 2.0, before I do think we will get a takeoff with the big qualifier that we don't know what Trump is actually going to pull off when he finally gets into his second term. Let's see, Ty, anything else on your mind for tonight before we log off?
Oh, Trump has really fulfilled me. Just talking about Trump anytime is so fulfilling. It barely brings any frustration. My concept of reality.
No, it is very. I'm glad you're excited. I'm glad. I know, Ty, you said, God, I wish I could be imported into America myself. But now I'd only get 75% of you. So
that's right.
I'll keep
you.
Right.
Well, you would get all of me. You would just be paying 25% more, right?
That's a very good point. That's a very good point.
I'll still get the same amount, for being bought. Right, works out for me. Carry on, USA, right? So
that's a very good point. Wow. I guess what I'm trying to say then is I can only afford 75% of you because of that now.
Oh,
yeah.
then it looks like you'll have to take out a private sector loan to make sure you can buy all of me, because you can't buy 75% of me.
Do you need anything below the knees, though? I mean,
that's the most important part. The most, you can't see it when people see me on the internet land, right? Yeah, it doesn't seem like it's an important part, but my legs are moving.
Yes,
my legs are always moving. I've got a counter on my phone that actually tells me they're always moving. I have a dog and I have to walk him.
Taking your steps. We do have two questions. We do have two questions on the way out. So actually, maybe we can hit these up. Give me 1 second. I was queued up to go to the disclaimer and call it a night. But question number one, Doug, can you talk about fiscal flows in relation to asset classes? Can the S&P be trading too high against the intrinsic value, moving into different asset classes where there is? Yes, I can speak to this. This is one of the things that I'm kind of studying. I am researching kind of literally as it speaks right now. One of the things that we will be exploring. Yes, the answer is yes. One of the things that we can do with the simulations we can run, and what we're very confident. And I see the second question there, Frank. Why do you see inflation? We could talk about that in just a second. But we do feel very confident about kind of our we'll call it our 6-month horizon forecast, right? Like what's on the horizon 6 months down the line. And there is certainly a rotation. I think a really good way to look at this is kind of the classic risk parity, what Ray Dalio pioneered 50 some odd years ago or 40 years ago with kind of the inflation growth quadrant idea, right? You can have high inflation, low inflation, high growth, low growth. If you lay that over in a grid, you get 4 quadrants. And as you move through those quadrants, different outcomes happen, right? And so the idea with risk parity is target risk and invest based on each one of those 4 possible outcomes in a full cycle rotation. And our thought process is, okay, well, we actually know where we're at in that cycle from kind of a risk parity standpoint. What performs, like if risk parity says we don't actually know where you're at in the cycle, but we know where we can, or where you're headed in the cycle, so just diversify your risk across all the cycle, all the inflation growth cycle. We're saying no, target it. And so what we would be saying is, yeah, you actually can get ahead and say something like, I really do think that over the next, say, 6 months, what you are going to see is you are going to see a shift of outperforming asset class. And in this case, it's been the S&P 500 relative to, say, small caps, or large banks relative to smaller banks, say for the last 6 months. But I think we're hitting that inflection point where we're actually going to see rotation. And so, yeah, I do think things like small caps, like regional banks, which have just been firing higher recently, should play out a little bit better, all things being equal, relative to the overall market over the next 6 months, because we are shifting kind of where we're at in regimes with a little less growth and falling inflation, which is, I think, what the next 6 months brings. But yeah, after that, which is what Frank is asking about, why do we see inflation go up? That'll change. But and on that point, if that's intriguing to you, make sure you head on over to AppliedMMT.com, and obviously we talk about that a lot more over there in those updates. Why do we see inflation taking off into the second half? Or really, I would say we'll really see the surprise of inflation in 2026. So the baseline here is that as the baseline argument is that as the business cycle plays out, dynamics occur where you get an expansion of private debt, you get the business cycle to increase, you get a thinning out of unemployment and a very strong demand on employment to go ahead and hire the labor to run the machines to expand output. And as that occurs, you get an inflection point of inflation where you end up seeing the input cost into your output increase. That gets passed off as markups, and those markups end up becoming a contributing factor to inflation. And Ty, feel free to cut me off if you want to add some more in there. But our point is, we have been really for the I would say 2022 into 2023 was if 2022 2023 that was really the downforce of the last cycle. We are literally at the bottom stroke and just starting to pick back up into the next business cycle, right? And so we are now in the upswing of the next business cycle, and so we will be getting to that inflationary inflection point as the next business cycle really takes off. And so that's why I think we'll be seeing inflation as we head into 2026. And how bad that gets remains to be seen, but just the natural progression of the inflation cycle kicks off at that point in time.
Yeah, no, I 100% agree. Right now, we're kind of working on our next. We kind of update our model every week, and just kind of looking at we don't take a year and a half and 2 year forecasts set in stone, but it gives you it's kind of like if it's going to be a La Nina year or an El Nino year, right?
Yeah,
we can see that far off in the future, and we do see a pickup in growth in late 2025. We see unemployment really it might we're getting close to the peak. So we'll see a drop all through 2025. And we do see a pickup in inflation in 2026. What degree at that point, all things equal, from 2%, we could see 3, 4, or even 5% potentially, right? And of course, with all the exogenous things happening domestically with Trump, and then globally with Ukraine and Israel and the Middle East, energy prices, a whole lot of things can happen, right? But inflation is always transitory. I remember the big, the transitory talk a few years ago, and I always laughed at it because inflation is always transitory. It's a flow, right? It changes all the time. It is a transitory thing.
Yes.
Now,
yes.
The price level could be somewhat stable looking, right? But the flow, which is inflation, is always transitory. There will be a period in the future when it goes up. We have pretty sophisticated models where we can pretty much get it down into a couple month range, 2 years out, where we know where inflation's going to start picking up or accelerating. So it's always going to go up in the future, and it's always going to go down.
Come back
right?
down. Yes. Yes.
Yeah, that's what it does.
Have you ever seen that chart of like the 200-year historical inflation deflation chart? Let's see if I can find this real quick. Like if you go back to like the 1700s, yeah, this is such a great chart. God, I love this.
Let's put it up on.
I will. Yeah, I found it. I'm just trying to get it up on the tab. There we go. And we will now. There we go. Here is inflation, 1775 to present, and there are two lessons. There are two lessons we want to learn from this, but lesson number one is inflation goes up and down.
Is the second lesson the same lesson that I was going to say, or do you want me to?
The second lesson is, holy cow, we've got a lot better handle on inflation since we went off the gold standard.
So if you look at, obviously in the 1800s, we go through these massive periods of instability, negative and positive inflation swinging both ways. Now, the Austrian school will show the stock of this line over time, and they say, oh, look at how flat it is, and then of course it shoots up like a hockey stick where it's all red because we now control our price level, so it's always expanding. We don't go through periods of instability where prices are falling, which are very, very detrimental to businesses. So it's very important. They'll say, well, how could it be instability? We had a flat line through the 1800s. Well, no, you went into, because any gains you got, you went into a crisis. And you saw, I'm seeing some of the worst of it there, 10%, 15% deflation. Imagine running a small business and you have to charge 15% less for the products you sell. How are you going to pay your employees now? You're not. You're going to fire them. Right? So deflation is a sign of instability in a capitalist economy. So Yeah, there's a lot of lessons to be learned by looking at this chart, and I could go off for an hour, but we're not going to do that. We're going to get Doug to say, where you can find us online and do all that stuff.
Yes. Yeah. Again, I think this is the third plug tonight, but whatever. AppliedMMT.com. Get all that information, get all the data, get all the models. Head on over there. And then also Modern Macro Tech. Yeah, links will be in the description. But that's where we're at. That's where we're at for tonight. Ty, good chatting again. Chat. Thanks for dropping by. Some good questions tonight. Good discussion. So until next time, good trading, everyone. And we'll talk to you soon. Good night.